Well, good morning, John. It's good to see you again after we had Will and Steve on last week talking about the Australian reporting season. John, you spent some time in Cairns visiting clients, doing presentations, so perhaps you can give us some feedback from that. But probably the biggest narrative in markets since we last spoke was Jay Powell, the chairman of the Federal Reserve, giving his annual speech at Jackson Hole. And he made perfectly clear that the Fed is now pivoting to rate cuts, and we're expecting a rate cut on the 18th or the 19th of September when they next meet. John, how much has that pivot supported global equity markets, and is that going to flow through to Australia as well?
No, I think the important thing is, Paul, it's now well baked into markets. I mean, there'll be no surprise when interest rates are cut. There would be a surprise if they cut them 0.5%. I think that would be a surprise, and that would indicate severe weakening in the labour market in America. I think that was the message from Powell. Whilst interest rate cuts are positive, when they're baked into markets, we've got to be careful that it's not already priced in, and therefore the knee-jerk reaction on an interest rate cut is for asset prices that pull back initially before they reassess. And I probably think that's probably more a risk than not this time around, because the forecast of cutting interest rates has been in the markets, and we've been talking about it endlessly, Paul, I guess almost for a year now. So that is in the back of my mind, and I think we don't trade the markets, but certainly our dealers in acquiring stocks will be aware of that. So clients can be well assured of that. So in terms of Australia, I think we will follow, but it's later in the year. I'm doing a thought piece now for First Links regarding housing prices and the interest rate cycle, and connecting the dots. And Australia's got a highly leveraged household position, and it needs interest rate cuts to help the household sector, that part of the household sector which is heavily geared and has suffered real wage declines. So look out for that.
Yeah, John, so that just confirms that the transmission mechanism of monetary policy on real household income is greater in Australia than in other countries because of the structure of our mortgage market and so on, meaning that when rates are high in Australia, it really affects household incomes to a greater extent than in most other countries. Is that what you're going to be kind of spelling out?
Yeah, well, look, if you look at low middle income earners who have got a mortgage, who have bought houses in the last 5 years, they are in a seriously difficult situation because, as you say, interest rates have gone up. That's cut into their after-tax income. And then their real wages have not matched inflation since COVID. They were doing quite nicely before COVID. I think that's not well understood. Real wages rose in Australia. But since COVID, and that spike in inflation and still the repercussions of electricity and petrol prices and index pricing by governments has caused decline in real wages. The Reserve Bank's well aware of that. I keep on saying I don't really believe anything the Reserve Bank of Australia says in terms of the risk of putting up interest rates. It's just not going to happen. And I think we will see. Now, we're talking before an inflation data today, Paul, so people should be aware of that. That'll tell the tale. I think the expectation is the headline figure will be reasonably good. The underlying figure is the unknown. But I think it's quite clear that the trend for inflation is down no matter what the Reserve Bank says. And that's good news in terms of monetary policy, and sets the scene for a reasonable calendar 25, subject to announcements made recently regarding student numbers and immigration, which I know we're going to talk about.
Yeah, so we'll come back to that. But in the meantime, we're expecting the Fed to cut in September. But I'm assuming that you don't think the RBA will be in a position to cut until the new calendar year. Can you just confirm that, John?
It could be Melbourne Cup or new calendar year. It depends on the inflation numbers and the certainty that inflation's coming down. I don't think we've got an employment problem in Australia. What I perceived in Cairns, and I think in all tourist destinations, the aged part of the Australian, the retired part of the Australian household sector is travelling around and spending money at a great rate, and I could see that in Cairns. The other thing I did see, and it's a big issue, is the number of short-term visa holders, and I guess people have come here to be educated who are working in the services sector. You don't talk to Australians when you go to restaurants. You don't talk to Australians when you go to cafes or hotels.
No.
These people are coming here on visas and working and enjoying Australia. It makes you wonder why there's any unemployment in Australia. I just think there's an underlying problem in Australia about people who don't want to work, who should be working, and I don't know if we encourage them enough, but that's another story.
Yeah. I'll just give you a personal anecdote. My wife was involved in the restaurant business, and when they advertised looking for kitchen hands, not a single Australian would be applying, and they'd get lots and lots of applications from people who were ostensibly here on student visas, from the Philippines or Nepal or Vietnam, and Mediterranean countries as well, South American countries, but not locals. Anyway, John, so the interesting intersection between the tourism industry and the education sector. I think the tourism industry is possibly a bit bigger. They each contribute something like 30-40 billion dollars per annum to GDP. But there's a lot of interrelationships. So students come here and then travel around Australia, and their families come and visit them and so on. So they really participate in the tourism sector. Are we making a mistake by limiting numbers to 270,000?
It's a big issue. It's a big macro issue. Yes, there is a part of that cohort who adds to demand for housing, certainly adds to demand for rental, and maybe the two arguments are being misunderstood. How much, or how many of these students or their families are buying property in Australia and adding to the excess demand over supply, I think is a little bit overstated, but I certainly think they add to the demand for rental accommodation. But on the flip side, they add to the supply of service labour and keep that part of the economy buoyant. I think what we're seeing, Paul, is a complete lack of planning by Treasury. I think we've got to get back to the point that the haphazard nature of policy settings in this country is becoming ridiculous. The change in policy for students, overseas students, is 9 months. So they made an announcement 9 months ago and they're changing it. Now, I'm not here defending universities, but they're trying to run a business. There is lots of arguments both ways that international students add strongly to the education, export income of Australia, yes, and add to jobs in Australia, yes, they do. But is it done excessively? I think there's some arguments. Are the right courses being offered? Are we sort of over complicating our education system and unfairly towards Australians? Look, they're all big issues, and I don't see any think tanks. I don't see any thought process, white papers or anything. It just seems to be a schmozzle. And then when you overlay it with the immigration policy, where we just immigrated 1 million people over the last 3 years without any thought process about infrastructure or education, healthcare, it's a real blight above planning of Australia. And it needs to be fixed up because it causes these changes in policies. And those participants in those industries, and now we've got the education sector saying, well, we can't plan ahead. And we've invested heavily to take higher levels of students, and it's not going to come now. and it's affected our financial models. It's not good.
Yeah. John, at the moment, we're, the rest of the investment team are very involved in looking at the reporting season, individual companies. But are you getting a sense of how that's going? I know that you don't focus on individual companies as such, but, we've seen BHP's results coming out talking about, perhaps iron ore, which is our biggest export commodity, going through a more difficult period. We're seeing copper slightly better. We're seeing the Australian dollar creeping up. Are there any themes from reporting season or sort of macro events that are concerning you at the moment? Or
well, I don't get concerned. I just make observations, and I think the interesting thing is the weighted average earnings as opposed to probably the median earnings. Like, I think earnings growth is there, and more from the developing, faster growing, smaller companies. The larger companies, when you take a weighted average, they are going to dampen down earnings growth in Australia for the next 12 months. You've got BHP and the iron ore sector probably looking at lower earnings.
Yeah.
And that's a big weight. The banking sector, yes, will probably grow 2 to 5%, but that's a big weight and very low growth. And I'm seeing analysts' expectations for EPS market growth of 12% for the next 12 months. Well, that's not going to happen on a weighted average. It's going to come way down to 4 or 5%. If we are going to get double-digit earnings growth, it's not going to be from the top end of the market. And that's an interesting conundrum, Paul. We've got PEs, but the PE of Commonwealth Bank at over 20 times forecast, which is, that doesn't look logical when growth is only 5%, if that. So we've got a mismatch there.
It's interesting because this morning I was actually quite shocked to look at where the market is at the moment based on next year's forecast earnings. It's actually they said it was this is Goldman Sachs, I think. They said that the ASX was on a PE of 17.9.
Yeah, well, it's heavily weighted to the banks and the resource sector. Now, we know in cycles, and it's worth remembering, that the lowest point of PEs for resource companies is the highest peak of commodity prices. And then the PE expands, and the trick to it is looking through the PE and looking for recovery. But we've got 12 months to 18 months at least of declining commodity prices, not metals prices, as you've stated on copper. So there is an issue there in terms of an index. The index might twaddle along, but there will be individual sectors away from the top part of the market which will start performing. And I think that's will be a feature of our investing in the next 12 months in terms of trying to pick the sectors away from the major parts of the market. Now, what that introduces is volatility, because small companies have a lot more volatility, I guess more risk, but the potential for return. Just got to be very careful. It is an inflated asset priced world. And we're going to get more asset price inflation. And my strong view is, and we'll see from the election in America, the debate, there'll be no debate about fiscal policy. The fiscal policy of America is out of control. The government debt's out of control. However, interest rates are coming down. I think we'll see the return of QE, which will be flooding financial markets with liquidity. I don't think there's any way out of this debt situation going forward. And that creates asset price inflation and PE expansion. So we've got all these headwinds and tailwinds, Paul, which that's why we talk weekly, because they do change, wax and wane. But I do want to put statements out there to help people invest, to say, look, it's never easy investing, but crikey, the number of issues in terms of government debt internationally and Australian household debt, we have to be aware of it and how the regulators will respond.
Yeah. Year to date, I think our market is up about 6.3% thereabouts. Do you think we'll get to double digits over the calendar 2024?
Well, I wouldn't surprise me. I mean, when you add back the dividend, we'll clearly get there, and the franking. The outlook is pretty good for Australia. I mean, we've not the best managed economy in the world. We've got a strong fiscal situation, population growth, which will come through, and it starts to multiply. Its effect comes years after people enter Australia. The issue about, as we talked about, I think tourism remains very strong. The Aussie dollar is undervalued. It's remarkable the number of people coming from Asia to places like Cairns. It's quite extraordinary, Koreans and Japanese. We don't see it as much in Sydney and Melbourne, but they really do hit the northern part of Australia and spend big money and go on tours, and it's good. So I'm relaxed about the outlook for Australia. I'm just not relaxed about how the place is being managed and the long-term planning. It just seems non-existent.
Okay, thanks, John. I think we'll leave it there. Interesting discussion as always, and we will revisit, some of the numbers that are released today, like the inflation number. I guess we'll address that next week.
Yeah, and Paul, I think next week we're inviting the small cap team. I think that's the interesting area of the market. So we'll get the small cap analysts to tell us how the results are looking and what the outlook is. And I think we'll find that the outlook from smaller companies and the middle market is much, much better than the top end of the market. And that's just something for our viewers to understand.
Great. Okay. Look forward to it. Thank you so much, John. And to the audience out there, stay well, and we will see you next week. Thank you.
Thanks.